It's not governments. It's not even the big banks. The world's financial system is built on a set of rules written by a secretive, non-elected organization that almost no one has heard of. This is how they took control in a nondescript building. In Basel, Switzerland, a handful of central bankers and financial regulators meet regularly to decide the rules that govern global finance. They are not elected. They answer to no one. They operate with minimal transparency and almost no public accountability. Yet their decisions affect billions of people worldwide. They determine how much capital banks must hold. They set the standards for what counts as acceptable collateral. They define the rules that determine whether a bank is solvent or insolvent. This organization is the Bank for International Settlements, and it has become the shadow government of global finance. The BIS was founded in 1930 to manage German reparations from World War I. It was originally a modest institution designed to handle a specific financial problem, but it evolved into something far more powerful: the Central Bank for Central Banks. Today, the BIS coordinates monetary policy across the globe, sets standards for banking regulation, and essentially functions as a world central bank without any democratic legitimacy or public authorization. Most people have never heard of the BIS. Google it, and you'll find a dry Wikipedia page describing it as an international financial institution. Check its website, and you'll see official statements about promoting monetary and financial stability. But these descriptions obscure the true nature of the organization. The BIS is where the real decisions about global finance are made. The Basel Accords, agreed upon by BIS committees, determine banking regulations for virtually every country in the world. When the BIS decides to tighten capital requirements, banks worldwide are forced to adjust. When it decides to loosen requirements, the entire global banking system shifts. The Basel Accords are named after Basel, Switzerland, where the BIS is headquartered. Basel I, adopted in 1988, was the first attempt to create uniform banking standards globally. Before Basel I, different countries had different banking regulations. A bank could shop for the friendliest regulatory environment and concentrate its risky activities there. This regulatory arbitrage undermined financial stability. Basel I attempted to level the playing field by establishing minimum capital requirements that all major banks would follow. The agreement was revolutionary. For the first time, countries voluntarily surrendered some regulatory authority to an international body. Basel I set a standard that banks must hold capital equal to at least 8% of their risk-weighted assets. This sounds technical, but it's fundamentally important. Capital is the buffer a bank maintains to absorb losses. If a bank's risky, assets decline in value. The capital absorbs the loss. If the capital is depleted, the bank is insolvent. By requiring banks to hold capital proportional to their risks, Basel I aimed to ensure banks wouldn't take excessive risks. But Basel I had a critical flaw. It allowed banks to determine their own risk weights. A mortgage was considered lower risk than a corporate loan, so mortgages required less capital backing. This created perverse incentives. Banks could take enormous risks and minimize capital requirements by classifying their assets as low risk. This was exactly what happened in the run-up to the 2008 crisis. Banks loaded up on mortgages and mortgage derivatives, which were classified as low risk under Basel B-Farsing. When the mortgages defaulted, banks discovered they had far less capital than they needed to cover the losses. Basel II, adopted in 2004, attempted to fix these problems by creating more sophisticated risk-weighting methodologies. But Basel II gave banks even more freedom to determine their own risk weights using internal models. The result was predictable. Banks gamed the system, using mathematical models to minimize capital requirements on their riskiest assets. The models were based on historical data that assumed financial crises were rare events. When the 2008 crisis hit, the historical data proved useless. The models failed catastrophically. Banks discovered they had vastly underestimated their risks and held insufficient capital. After 2008, the BIS implemented Basel III, which significantly increased capital requirements and added new measures to ensure banks maintained sufficient liquidity. Basel III represented a genuine tightening of global banking regulation. But even with Basel III, the fundamental problem remains. The BIS and its committees operate with almost no public accountability. They make decisions that affect billions of people, yet they're accountable only to themselves. The Basel Committee on Banking Supervision is the BIS subcommittee that actually writes the banking rules. The committee includes representatives from central banks and regulatory agencies from roughly 30 countries. These representatives are not elected. They're not confirmed by any parliament. They're bureaucrats appointed by their respective governments. Yet they have the power to set standards that affect global finance. When the committee decides to implement a new rule, banks worldwide must comply or face regulatory sanctions. The secrecy surrounding BIS operations is remarkable. The institution publishes reports and holds conferences, but key discussions occur behind closed doors. The minutes of Basel Committee meetings are not publicly available. Observers are rarely permitted to attend sessions. When the committee gathers to discuss new regulations or coordinate monetary policy, the public has no way of knowing what's being discussed. This secrecy is justified on technical grounds. The argument that financial regulation is too complex for public debate. But secrecy also serves another purpose. It insulates decision makers from democratic accountability. The concentration of power at the BIS is extraordinary. A small group of individuals in one building can make decisions that ripple through the global economy. When the BIS signals concern about systemic risks, financial markets react. When the BIS announces new capital requirements, banks adjust their behavior worldwide. The BIS effectively functions as a shadow world government for finance, with more real power over global banking than the United Nations has over geopolitics. The evolution of the BIS from an institution handling post-war reparations to a global financial governance organization happened gradually and almost unnoticed. In the 1970s and 1980s, as financial markets became increasingly globalized, central banks recognized the need for international coordination. The BIS became the forum where this coordination occurred. Informal arrangements evolved into formal committees. Voluntary standards became binding commitments. Over decades, the BIS accumulated more power without any formal transfer of authority from governments or democratic institutions. The relationship between the BIS and individual governments is complex. Central banks theoretically answer to their governments. The Federal Reserve Chairman reports to Congress. The European Central Bank answers to European Union institutions. But in practice, central bankers view themselves as independent professionals whose job is to maintain financial stability, not to serve political masters. Central banks in developed countries have successfully resisted political pressure to implement policies they view as dangerous. This independence is valuable. It prevents populist politicians from debasing currency for short-term political gain, but it also means that crucial financial decisions are made by unelected technocrats insulated from democratic accountability. The BIS has been criticized for implementing policies that benefit the wealthy at the expense of ordinary people. After 2008, the BIS pushed for austerity and strict capital requirements, which limited banks' ability to lend and constrained economic growth. Critics argue that this policy prioritized bank stability over employment and economic development. The austerity imposed during Europe's debt crisis, justified partly by Basel III capital requirements, devastated economies and triggered social unrest. Yet, the decision-makers at the BIS faced no electoral consequences for these policies. The lack of transparency at the BIS creates opportunities for insider dealing and information asymmetry. Central bankers who meet at the BIS gain advance knowledge of policy decisions that will be implemented in their respective countries. This knowledge could theoretically be used for profitable trading. While laws ostensibly prevent this, enforcement is difficult because the relevant transactions occur inside the financial system itself. A central banker can't personally profit from foreknowledge, but their associates or financial institutions can. The information asymmetry between those inside the BIS and the general public is immense. The power of the BIS extends beyond banking regulation. The organization has become the coordinator of central bank monetary policy globally. When one major central bank changes policy, it affects others. The BIS facilitates these policy coordination mechanisms. During the 2008 crisis, the BIS helped coordinate emergency lending facilities among central banks. During the pandemic, the BIS helped coordinate emergency asset purchases. Each time, decisions that affected trillions of dollars were made by central bankers coordinating through the BIS with minimal public input. Some defenders argue that the BIS operates this way, necessarily because finance is too technical for democratic deliberation. They point out that complex financial regulation requires specialized expertise. Ordinary citizens, they claim, cannot evaluate the technical merits of different capital adequacy ratios or risk-weighting methodologies. This argument has some truth. Financial regulation is genuinely technical, but it's also fundamentally a question of values. Who bears the risks when financial systems fail? Should banks be constrained to prevent crises even if that limits economic growth? Should financial stability take priority over full employment? These are political questions, not technical ones. They deserve democratic debate. The future trajectory of the BIS is uncertain. Cryptocurrencies and blockchain technology could undermine the need for centralized banking infrastructure. But for now, the BIS remains the hidden master of global finance. Most people going about their lives never think about Basel Accords or central bank coordination. They see interest rates set by their central bank and assume these decisions are made independently. They don't realize that central bankers are coordinating through the BIS. They don't know that global banking standards are set by secretive committees in Switzerland. They don't understand that the rules governing their financial system were written by unelected technocrats. This concentration of power in unaccountable institutions is perhaps the defining feature of modern finance. The appearance of democratic control, governments set monetary policy, parliaments pass financial regulations, obscures the reality that crucial decisions are actually made by central bankers and financial regulators coordinating through the Bahes. Until this hidden governance structure becomes visible and subject to democratic accountability, the world's financial system will remain controlled by an invisible master that almost no one knows exists.